Listen to me very carefully. At this exact moment, you are standing in front of a door. On one side of that door is generational wealth, on the other side is financial ruin. And the institutions that dominate this system are doing everything possible to make sure you choose the wrong path. They need fear, they need panic, they need you to sell before you fully understand what just happened. Friday, February 13th, 2026, this is the Money Engine, and today we are going to talk about what may be the most sophisticated financial robbery of modern times, not something buried in history, something that unfolded in the last 48 hours. And if you failed to recognize the structure that just printed itself onto the silver chart, you are about to miss what could become the most explosive rally in precious metals history. 2 weeks ago, silver traded at $120 per ounce, the highest price ever recorded. Gold surged beyond $5,600. Momentum was relentless. Central banks were accumulating. Retail investors were flooding in. The squeeze was undeniable. Technical indicators were aligned. Fundamentals were locked in. The global supply deficit was obvious and persistent. And then, on January 30th, the floor collapsed. Not gradually, not subtly, violently. Silver fell from 106 ties to $73 in a single trading session, a $43 plunge in hours, a 36% intraday collapse that erased billions before most participants had time to react. That was the first strike, what technicians call the left shoulder. After that shock, silver stabilized. It climbed back to $84 over the following week. Breathing resumed. Analysts declared the worst was behind us. Then came yesterday, Thursday, February 12th. Another coordinated dump. Silver fell from $84 to $73.86 at the intraday low, more than 10% erased in one session. The right shoulder, the final test. The last psychological blow intended to shake out every remaining holder before liftoff. But here is what changes everything. Today, Friday, February 13th, silver is trading at $77.32, up $2.13, a 2.83% recovery. Gold is rebounding as well. The bounce is not random, it is not emotional, it is technical, it is structural, it is mathematical. What we are witnessing in real time is the completion of one of the most powerful bullish reversal formations in technical analysis, the inverse head and shoulders pattern. If you do not understand what that implies, you must pay close attention, because this pattern carries a measured move projection of $104. Let's break down what just formed. After the first crash, silver found support near $74. That zone absorbed enormous selling pressure. Futures contracts were dumped, margin requirements were raised, negative media narratives intensified, yet $74 held. Buyers stepped in aggressively. That was your left shoulder, institutional support revealed. Then came the head, the panic event. On January 30th, silver plunged below $74 and collapsed to $64. That was forced liquidation. That was stop-loss hunting. That was leverage being purged from the system. Algorithms chased every weak position out of the market. But here is the key detail. The rebound from $64 was immediate and explosive. It did not grind upward slowly. It snapped higher. It reclaimed $70 almost instantly. It surged through $80. It reached $84. That behavior tells you the drop to $64 was not organic selling. It was forced liquidation, followed by aggressive accumulation. Then yesterday's move carved the right shoulder. For an inverse head and shoulders to complete properly, the market must retest support one final time. Sellers attempt one more push, bulls are tested. Yesterday's intraday low was $73.86. Do you see the significance? That low was dramatically higher than $64. It was even marginally above the prior left shoulder region. That is a higher low. That is sellers showing exhaustion. 2 weeks ago, they could drive silver to $64. Yesterday, they could only push it to $73.86. Each assault produces diminishing returns. The floor is rising. The neckline of this formation lies between $84 and $88. That zone represents resistance. Once price breaks above that level with conviction, the technical target is calculated by measuring the distance from the head to the neckline and projecting it upward. From $64 to $84 is a $20 range. Add $20 to the breakout zone, and you arrive at approximately $104. That is the measured move encoded within the structure. Today's rally to $77 is not noise. It is stabilization after the right shoulder test. The structure is intact. The spring is compressed. Now let's discuss what triggered yesterday's engineered drop. At exactly 9:14 a.m. Eastern Time on Thursday, a Bloomberg alert flashed across trading terminals. 13 words. Sources say Russia considering partial reversal of dollar ban for select energy trades. 13 words erased over 10% of silver's value within 90 minutes. Understand the psychology. The metal's bull market since 2022 has been fueled by de-dollarization. Sanctions weaponized the dollar. Russia refused dollars for energy exports. China increased yuan settlement. Saudi Arabia loosened the petrodollar framework. BRICS nations initiated gold-linked settlement systems. Those developments undermined dollar dominance and pushed capital toward tangible assets. Gold rose from $1,900 to over $5,000. Silver climbed from $24 to $122. Now imagine a rumor suggesting Russia might reverse course and accept dollars again. That narrative undermines the de-dollarization thesis. Algorithms scanning headlines react instantly. Within minutes of that alert, tens of thousands of futures contracts were dumped. Machines do not verify facts. They trade keywords. But here is what matters. There was no official policy announcement, no Kremlin press conference, no signed directive, just anonymous sources. In the past 6 months, Russian officials repeatedly reaffirmed commitment to reducing dollar exposure. Statements emphasized increasing gold reserves, expanding ruble and yuan settlement, and minimizing dollar holdings. Does that align with an imminent reversal, or does it contradict the rumor entirely? The timing was surgical. The rumor appeared immediately after weak economic data that should have supported metals. Confusion was engineered. Traders did not know which signal to prioritize, so they sold. 2 full days of weekend narrative spread would amplify fear. Casual investors would see headlines, weak hands would liquidate. Meanwhile, insiders accumulate at discounted prices, and today, 1 day later, silver rebounds. The pattern holds. Now we must address why these violent collapses keep occurring despite clear physical shortages. There is a hidden pressure valve in the system, a mechanism that temporarily masks scarcity, and that mechanism is in China. In Western markets, there is one dominant spot price anchored to futures trading. In China, 2 parallel markets operate: the official Shanghai Gold Exchange, SGE, and an extensive decentralized scrap and recycling market. China imposes a 13% value-added tax on precious metals sold through official channels. A 1 kilogram bar purchased through the exchange includes that VAT. If spot is $75, the real cost through official channels may approach $84.75. However, small-scale recyclers operating below certain revenue thresholds are exempt from VAT. They can sell recycled silver without the 13% tax burden. Consider the incentive. If official exchange bars cost nearly $85 due to VAT, but recyclers can sell scrap at $75 tax-free, buyers gravitate toward scrap. When the official exchange restricts supply, prioritizing industrial or strategic demand, scrap supply floods into the market. Households melt heirlooms. Electronic components are stripped. Old inventory is liquidated. This creates the illusion of abundant supply. But scrap is finite. You can only melt down stored wealth once. This wave of grassroots recycling functions as a temporary release valve. It suppresses premiums and dampens price spikes. But it does not represent sustainable mine production. Global mining output has not surged. In fact, primary production has stagnated or declined. The scrap surge represents one-time liquidation of accumulated assets, and it cannot continue indefinitely. That is why recent crashes are weaker than earlier ones. That is why the right shoulder stopped at $73.86, rather than collapsing toward $60 again. The release valve is losing pressure. Now we are sitting at $77.32s. We watch $74 carefully. If $74 holds, the inverse head and shoulders remains valid. The neckline between $84 and $88 becomes the next objective. A decisive breakout activates the measured move toward $104. If $74 fails on a sustained basis, support reverts toward the $64 head region. But understand this clearly. Even a dip toward $60 would represent extraordinary value given the structural deficit and tightening physical supply. Either path ultimately converges toward higher valuations. Now look at the physical market. Attempt to buy significant quantities of physical silver at $77 spot. You will encounter either inventory shortages or heavy premiums. Dealers are not flush with supply. Premiums over spot remain elevated. Delivery delays extend. If this were a genuine bear market, supply would overwhelm demand. Premiums would collapse. Dealers would discount inventory to clear shelves. Instead, physical tightness persists. Mining companies are not eager to sell aggressively at suppressed prices. Refiners are cautious. Wholesalers protect inventory. The disconnect between paper price and physical availability is widening, and that divergence cannot persist forever. Now let's step back and examine the larger macro backdrop, because technical patterns only work when they align with structural fundamentals. And right now, the macro environment is flashing warning signals that cannot be ignored. The United States government is carrying approximately $38 trillion in national debt. Every single 1% increase in interest rates adds roughly $380 billion in additional annual interest expense. With rates hovering near 5%, interest payments alone are approaching $2 trillion per year. That figure rivals, and in some projections exceeds, total individual income tax receipts. Think about the implications of that. The government is borrowing money to pay interest on money already borrowed. That is not fiscal stability. That is compounding fragility. When debt service consumes an ever-increasing share of revenue, the system becomes dependent on perpetual refinancing and expanding liquidity. So what happens if bond markets demand higher yields? What happens if Treasury auctions begin showing weak participation? The Federal Reserve faces a choice: allow rates to spike and risk systemic collapse, or intervene with aggressive monetary expansion. History suggests intervention. And intervention means currency creation. When liquidity floods the system at scale, tangible assets reprice, not gradually, but violently. Precious metals do not simply trend higher, they accelerate. Institutions understand this dynamic. That is why they accumulate quietly during periods of engineered volatility. That is why rumors appear precisely when technical patterns near completion. That is why violent corrections occur just before breakout structures confirm. From January 29th to yesterday's low, silver fell from $122 to $73.86, a $48 drop, nearly 39% in 2 weeks. Gold retraced sharply as well. And during that entire collapse, did industrial demand disappear? Did solar manufacturers halt production? Did electric vehicle expansion pause? Did electronics demand contract? Did emerging markets reverse their reserve diversification strategies? No. Nothing fundamental changed. The only variable that changed was the paper price, and paper price can be influenced by leverage. Meanwhile, the physical market tells a different story. Dealers report persistent demand. Certain products command premiums well above spot. Replacement costs remain elevated. Supply chains are tight. If spot price were truly reflective of oversupply, dealers would be overstocked. Instead, many are cautious with allocations. This divergence between paper volatility and physical tightness reveals stress in the pricing mechanism. Now return to the technical framework. We have left shoulder near $74, head at 64, right shoulder at $73.86, neckline between $84 and $80. Today's rebound to 77.32 signals stabilization. Volume patterns show diminishing downside momentum. Each subsequent sell-off has produced shallower lows. That is seller exhaustion. If buyers push through $88 with conviction, algorithms will flip from defensive to aggressive. Momentum funds will re-enter. Short positions will cover. That ignition point activates the measured move toward $104. Understand that this $104 projection is not arbitrary optimism. It is derived from structural measurement. The distance from head to neckline projects upward with statistical reliability. Inverse head and shoulders formations, when confirmed after strong uptrends, carry one of the highest success probabilities among classical technical setups. They represent transition from distribution to accumulation, and accumulation is precisely what appears to be unfolding beneath the surface. Now let's address risk honestly. If $74 breaks decisively, meaning sustained closes below that level, the pattern invalidates. In that scenario, support revisits the $64 region. Volatility intensifies, sentiment weakens. But here's the paradox. A deeper retracement into the 60s would not invalidate the long-term thesis. It would intensify the opportunity, because structural supply constraints and macro-monetary pressure remain intact regardless of short-term fluctuations. The destination does not change, only the route. One path is direct, the other includes turbulence. Both converge at higher equilibrium prices. Now consider global monetary trust. Fiat currencies rely on confidence. When debt burdens expand and fiscal discipline erodes, confidence gradually shifts towards scarce assets. Silver is not merely an industrial commodity. It has functioned as money for thousands of years. It survives political cycles. It outlasts empires. When central banks diversify reserves, they diversify into tangible assets. When individuals question purchasing power erosion, they seek stores of value. This is not speculation driven by hype. It is structural adaptation. We are observing the late stages of a cycle where leverage in derivatives markets attempts to suppress signals from the physical world. Paper contracts can be created in abundance. Physical ounces cannot. When derivatives dominate price discovery, volatility increases. But eventually, physical constraints assert dominance. And when that transition occurs, repricing can be abrupt. Now bring everything together. Silver at $77.32, 37% below its recent high of $120, a completed inverse head and shoulder structure forming, right shoulder higher than the head, indicating strength, neckline resistance within striking distance, physical market tightness persisting, macro debt expansion accelerating, interest burden compounding. If you held through both crashes without capitulating, you endured the psychological purge designed to eliminate weak positions. Institutions test conviction before large moves. They need to identify who will hold during turbulence. Now the turbulence is subsiding. The launch phase is not a headline, it is a structural progression. Breakouts do not announce themselves loudly beforehand. They compress, they coil, they release. When price clears $88 decisively, momentum shifts quickly. Volatility flips from downward spikes to upward expansions. Those waiting for perfect confirmation often enter at significantly higher levels. If you do not own exposure, you are looking at an asset recently priced at $122 trading near $77, with structural support beneath it and macro tailwinds behind it. If you already own exposure and withstood the drawdown, you pass the test. Emotional resilience is prerequisite to capitalizing on cyclical breakouts. For those who argue metals are too volatile, consider alternatives. Cash loses purchasing power in inflationary environments. Equity valuations remain historically stretched. Bonds face yield risk and currency risk simultaneously. Risk does not disappear. It transfers. Choosing not to hold scarce assets in an environment of expanding monetary supply is also a risk. What we are witnessing is not random chaos. It is a clearing event, a purge of excess leverage before potential repricing. The derivative tail attempts to wag the physical dog one final time. If physical tightness continues while paper volatility diminishes in impact, equilibrium shifts upward. So here is where we stand. Silver, 77.32, rebounding. Right shoulder intact at 73.86. Neckline between 84 and 88. Measured move projection near $104. Macro debt pressure intensifying. Physical supply constrained. The choice in front of you mirrors the metaphor we began with. One door leads toward ownership of scarce assets during a potential repricing cycle. The other leads toward reliance on paper systems under increasing strain. The pattern is carved. The structure is visible. The recovery has begun. Friday, February 13th, 2026. Silver stabilizing. Breakout potential building. The next move belongs to the market. The decision belongs to you.